Something big is happening right now in the global bond market that could reset the monetary system and directly impact the value of your dollars. Long-term government yields are rising everywhere, from the US to Japan to Europe. But this isn't just a boring financial technicality. This is a flashing red warning sign of what's to come next. Bond yields are the backbone of finance, and when they all rise together, it has serious implications for everyone. Mortgages, credit cards, car loans, business credit, even stock market valuations will all be impacted. But even beyond that, there's a new concerning shift, one that could reshape capital flows and slam US Treasuries, directly impacting the value of the dollar as well as gold and silver. And it all has to do with Japan. The Bank of Japan is stepping back. After decades of yield curve controls, near zero interest rates, and bond buybacks, Japan is retreating as the buyer of last resort, which has jolted their long-term 30-year government bonds to yields not seen since the 1990s. Simply put, a bond is how a government funds its debt. Think of it like a government IOU promised to be paid back in the future with interest. That interest is the yield. So the less demand there is for said debt, the higher investors want to be paid, hence the higher yields. As fiscal uncertainty in Japan continues to rise, demand for their bonds drops, meaning the yields increase. But this isn't just an issue for Japan. In fact, Japan is the world's largest creditor. More specifically, Japan is the single largest holder of US debt. So as their yields rise, the gap between their yields and US Treasuries narrows, meaning the math for these Japanese investors changes very quickly. Most of these investors hedge their dollars back to yen, but as this gap narrows, their return on treasuries could fall below what they could just make back at home. Meaning, if Japanese investors start to pull out their funds to cover rising yields or invest back in home, something we're already seeing happening, then that creates less demand for US treasuries, less demand at a time when the United States is already struggling with existing demand. This forces the US to pay even higher yields to attract investors, pushing up the cost that's already so expensive of servicing our massive debt burden. But here's the real danger. See, the United States has always had something referred to as its exorbitant privilege, which is having the global reserve currency. Because of this, there has always been demand for our debt, but that is something we have seen changing rapidly over the last few years. In fact, after the United States weaponized the dollar against Russia, imposing sanctions and freezing and seizing their US reserves, there has been an accelerated push away from dollar holdings. With trillions in debt maturing over the next year and against a backdrop of declining debt, if Japan were to shift a portion away from US Treasuries, it could accelerate a funding crisis. A funding crisis that will undoubtedly impact all Americans, at first through higher mortgages and car loans, but even businesses that will struggle to get access to credit. We could see an increase of layoffs and a general slowdown in our economy. But the even bigger concern is that as the US grows more desperate to fund its debt, it could trigger a wave of government spending, forcing the lender of last resort, the Fed, to step in and buy our own debt, which, of course, would create far worse inflation than anything we've seen over the last few years. But if you still don't believe that the US is that intertwined with Japan policy, we already got a small taste of what a minor change in Japan can do over here in the United States last year during the August 2024 yen carry trade unwind. For years, global funds have borrowed hundreds of billions worth of cheap yen and taken that highly leveraged capital and poured it into US Treasuries, corporate bonds, the stock market, which worked fine as long as the yen stayed cheap and the rate gap stayed wide. But when the Bank of Japan started stepping back last year, the yen strengthened. Suddenly, trillions of dollars worth of all of these highly leveraged bets were flipped upside down, and investors started dumping their assets as quickly as they could, all at the same time. US Treasury yields spiked, there was a sharp sell-off in the US stock market, and while it didn't turn into a full-blown market crash, the speed and volatility exposed just how connected the US and Japan truly are. But here's the scary part. What we saw last year was just a small taste of what could happen next. Normally, when central banks hold or cut rates, you can expect long-term bond demand to increase and yields to drop because investors expect these to be a good place to park your funds, a safe long-term investment. But right now, the opposite is happening. Across the world, yields are rising everywhere from France, Japan, Canada, the UK, you name it. So what is going on? Could it be that soaring deficits, a record amount of global debt, persistent inflation, and central bank credibility being called into question is finally catching up with those in power? This week, the Federal Reserve is expected to issue a rate cut in the face of a weakening labor market. But that labor market is weakening into rising inflation, creating a contradictory situation for the Federal Reserve. Cut rates, hoping to revive the job market at the risk that inflation will continue to rise at a faster rate, or keep rates the same or even raise them to slow the rate of inflation, but you risk increasing unemployment and a weaker labor market. But this isn't just a hypothetical. In fact, jobless claims surged this week by 27,000, the highest number in the last 4 years, at the same time that inflation accelerated. And since we know we can't trust any of this data to begin with, it's probably grossly underrepresenting just how bad both of these situations are. If you have high unemployment with high inflation and a stagnant economy, you get the dreaded S word. Stagflation, a term that up until the 1970s, most economists didn't even think was possible until it happened. Following the delinking of the dollar from gold, the debt was so out of control that it wasn't even helping the economy grow. Growth stalled right as prices were soaring. Paychecks lost their purchasing power, mortgages were double-digit, and bills went through the roof. In fact, during this period of time, U.S. government bonds were actually called certificates of confiscation, a nickname, because they were worth so much less as inflation continued to rip higher. This brings us back to the bond market and the warning sign we are seeing today. The debt is too extreme. If central banks are signaling rate cuts or they're holding steady and yet yields continue to climb, it's because the illusion is broken. This signals a structural reset, but those in power already know this, which is why they're piling into gold. In the 1970s, while Americans lost half of their purchasing power over the course of a decade, gold jumped from $35 an ounce to $850 an ounce, a nearly 2,300% increase in 10 years. That kind of jump in price might sound extreme, but that is what happens during extreme currency devaluations. I would argue that the one we're in today, the one that's just getting fired up, is going to end far worse than it did during the 1970s. So yes, to answer your question, because I do read your comments and I see this question all the time, as the dollar continues to lose its value, as global debt continues to increase, as rate cuts happen, as the demand for U.S. Treasuries disappears, we can expect to see gold's price increase dramatically. The same way in the 1970s that people who held their wealth in gold were able to protect their purchasing power and come out the other side in an even better position, those who held dollars lost everything will happen again. Only this time, the scale is going to be much bigger. The fallout will be worse, which is again why those in power are positioning themselves now with gold, not waiting until after. They are getting into position today. In fact, we study currency life cycles here at ITM because history has shown us time and time again what happens during a currency reset, how different assets perform, and most importantly, how you can protect yourself and create a lasting legacy, not only for your children, but for future generations to come, which is exactly why I will be hosting a free webinar next week, next Thursday, September 25th at 10 a.m. Pacific, Surviving the Reset, the 4 stages of currency collapse, and of course, how to protect yourself, where we are in the timeline today. If you have not already registered, please do so. You can do so by scanning the QR, let me know you're coming, or there's a registration link down below in the description. It is limited space. We ended up increasing the space because the demand was so high. I'm really excited because I'm going to be doing a live Q&A at the end as well, and I'm sure you have a ton of questions. So if you haven't already, let me know you're coming by registering, scanning the QR, or using the link below. And in the meantime, if you have any questions, as I'm sure you do, you can always call us. Find out how we can help you. We have an incredible team of analysts here. They have been studying this for years, most of them for decades, and have a ton of experience in helping people just like you create a strategy for what is coming next with physical gold and silver. And as always, thank you so much for being here. I'm Taylor Kenney with ITM Trading, your trusted source for all things gold, silver, and lifetime wealth protection. Until next time.